I've probably got the easiest job here, which is to introduce my good friend and colleague, Chris Adrian. She serves as the National 529 Specialist for JPMorgan Asset Management. In her role, she typically travels throughout the country to educate clients and advisors on college planning using the College Planning Essentials. Now, currently, Chris has been conducting these meetings virtually at her home, surrounded by her lovely family. And then before taking on this national role, she was an internal client advisor for over a decade with JPMorgan Asset Management, building advisory relationships with independent broker-dealers. She started her career in 2001 as an independent financial advisor focused on high net worth clients and estate planning. Chris holds a Bachelor of Science in Family Financial Planning from The Ohio State University, go Bucks, and she holds a Series 7 and 63 license and resides here in Columbus, Ohio. So enough of me here. I'll turn this over to Chris, who will talk with us about college savings. So Chris, please take it away. And thanks again.
Thank you so much, Brian. Thanks for the great introduction. And a huge thanks to Fitzgerald Financial for hosting us this evening on what is my very favorite topic. This is actually my 8th year as the National 529 Specialist for JPMorgan and my 20th year with JPMorgan. So that makes me feel a little bit old tonight. Also, my daughter Kate is actually playing the violin as we speak right outside my door. Hopefully you guys can't hear that through the audio, but very proud that she's already picking up the violin at a young age. But with that, today I actually wanted to share selected slides from a piece that JPMorgan puts out annually. It's called College Planning Essentials. And it's a piece that we actually update every February. So this upcoming February, we'll actually have some refreshed data, and we'll be sure to get that out to John and Larry to share with you, Crystal, and with your clients. But let me go ahead and share my screen if you don't mind. And I have selected slides that I've chosen to help articulate this conversation. So hopefully, thumbs up if you guys can see that okay on your screen. See that, Brian? Okay, great. So I'm actually going to turn to my very favorite slide, and that's the very first slide here. Let me go down. And that's my own 2 529 plan beneficiaries. I have my daughter Kate on the left and my son Joe on the right. My daughter Kate is actually reading The Principles of Real Estate Syndication. It was a gift from her grandpa, who runs a pretty successful real estate practice here in Columbus, Ohio. And his big hope is that Kate may be his succession plan for his real estate business. So he's starting her very early. She's actually the one that's playing the violin right outside my office. And on the right is my son, Joe. Joe is actually at The Ohio State University. That's my alma mater and my husband's alma mater. And Joe had just met Brutus the Buckeye. Brutus is actually the mascot of Ohio State. Pretty big deal when you run into Brutus. Sadly, I couldn't find the picture of Joe with Brutus, but I like this one because he was so excited and pumped up. And for Joe, he's actually an excellent golfer. He's actually been playing golf since he was big enough to swing a club. And we have very high hopes that maybe both of my children could get full rides. And for Joe, perhaps he would get a full ride playing golf. So with that, I wanted to turn to the first slide here in my deck, and that involves the costs of college. This helps illustrate inflation across the country. And as all of you know, inflation unfortunately has creeped up quite a bit over this last year. It's almost at 5%. In general, inflation is usually around 2 or 3%. So this most recent year has been quite high. But what this chart helps illustrate is tuition inflation in particular. And tuition is listed across the bottom in blue. What you'll notice is that over the last 4 decades, tuition has grown 822% over this time horizon, is one of the fastest growing household expenses in the country. And if you look just up above it, for example, medical care has grown half as fast. And for my own family, typically when I look at my own insurance premiums for medical care in particular, it grows extraordinarily fast. Tuition inflation absolutely dwarfs every other common household expense on this page. So very important to note, if you look at the bottom right in the little gray box, on average, tuition inflation grows about 6% each year. And that's important because a lot of families are saving for college, which is great, but they have the money earmarked in a checking or a savings account. And unfortunately, as we all know, checking and savings accounts are yielding very little today, if anything at all. Just to keep up with tuition inflation, we need to earn at least 6% each year. So that's why it's really important to think about not just saving for college, but investing for college as well. And that's why this particular chart, slide 9 from College Planning Essentials, looks so scary. And what I wanted to direct you to at the far right is that this year's average tuition, fees, and room and board is about $22,000 for the average public school and over $50,000 for the average private school. And that's why these numbers also look daunting, because when you factor in tuition inflation that we just discussed, if you look at a newborn, for example, on the far right, the purple bar represents 4 years all in at an in-state public school. And the blue bar represents 4 years all in at a private school. So for the newborn, roughly $230,000 to go to 4 years of public school. That's 18 years from now. And over $526,000 to go to 4 years of private school. These numbers are daunting to me. I mentioned I have 2 kids myself. There'll be roughly $300,000 combined to go to in-state public school, and double that, almost $600,000 to go to 4 years of private school. Those numbers are very daunting. But for my own family, we've chosen to have a goal. And one of the great things is that Fitzgerald Financial can help you determine what that goal might be for your own family and help you back into that goal. Help figure out how much you need to put in each month, quarter, or year to be able to achieve that goal. So very important to have a good understanding of what your number might look like in the future, and then how you might be able to help achieve that goal. So the second segment that I wanted to go into is financial aid. And quite often as we speak with families across the country, they'll say, yeah, Chris, those numbers are so daunting, but I think I'm going to receive a pretty large financial aid package to help offset those costs. So we've created this financial aid overview. On the left-hand side, what you'll notice is that over the last 10 years, college costs in blue have gone up 28%. And in contrast, if you look at the right in green, total financial aid packages, unfortunately, have come down 1%. So what that indicates is that families are being left paying even more out of pocket than ever before. And unfortunately, even during the COVID environment, that means that financial aid packages will be even smaller yet. So to help put some concrete numbers around that, we've created this slide. This is the financial aid reality check. And what I like about it is that it helps illustrate what the average is for families across the country in terms of a grant reality and also with a scholarship reality at the bottom. So at the top is the grant reality in blue. And just keep in mind that grants are free money. They're typically paid by the federal government, and they're based on financial need of the family. And some good news there, 48% of families across the US are eligible for grants. And on average, they'll receive about $6,000 each year towards their college costs. So if you look in the little tiny circles off to the right, underneath the blue books, it should cover about 9% of an average 4-year public school. At the bottom is the scholarship reality in green. Some really great news there is that anyone is eligible for scholarships. It is based on the merits of the student, and 58% of families across the US do receive scholarships, which is great news. On average, it's just under $8,000 each year. So again, if we look in the little tiny circles off to the right, should cover about 12% of an average 4-year public school. So while 12% might be covered by scholarships, hopefully, how do we help fund the other 88% of their college costs? And my very favorite stat on the entire page is in the upper right. That's 0.3%. And that's the average of all college students across the country who actually receive a full ride for college. So earlier I had talked about how my son Joe is a great golfer. We have very high hopes that perhaps he might receive a full ride playing golf. I often point to that particular stat, the 0.3% with my husband, and it really helps illustrate that that probability is so small. We're investing for college just in case, and if he is able to receive a full ride, that's great. We can actually use his balance for his baby sister, Kate. But I really like that particular stat because it is such a small probability. So next I wanted to go into the formula that the federal government uses when you fill out what's called the FAFSA. And the FAFSA is the free application for federal student aid. Every family across the country who has a student that's going to be approaching college or might be in college is expected or encouraged by the federal government to fill out the FAFSA, even if they think their family might not be eligible for much in way of federal financial aid. And the reason for that is because that number that the FAFSA helps illustrate is actually passed down to the college that your student might want to attend, and the college actually uses it to help determine your aid package as well. So one thing that we love to do in this particular slide is help illustrate what that formula is. What is that formula that the federal government is using to help illustrate your expected family contribution, or how much you're going to be expected to pay out of pocket each year? It's really two major components listed here on the page: the parent bucket on the left and the student bucket on the right. The biggest driver of the entire aid formula is parents' income. And what you'll notice on this page is it's actually a sliding scale. It's between 22 and 47%. If you're in a lower income tax bracket, you'll be closer to the 22%. And if you're a higher income tax bracket, you'll be closer to the 47%. But again, that is the largest driver of the entire aid formula. What I also think is important to note on this page is that parent assets, or those things that the parent holds in their own name, which can be checking or savings accounts, anything that's non-qualified. So if you have any non-qualified investment accounts or a 529 plan for college savings, it all counts the exact same. It's 5.64%, so really small percentage of the entire aid formula. And I think that's important to note because we often hear from families, Chris, I've heard that if I invest for college, I'm going to hurt my chances toward the financial aid package. And the reality is, if you have it invested in college savings like a 529, or if you have it in a checking or a savings account, it's all going to count the exact same. And that's 5.64%. The other bucket that I wanted to quickly highlight is the student bucket on the right. Students' income is 50% of the formula, but note in the little fine print, it is protected up to almost $7,000. So the good news is if your student makes less than that amount, you don't have to worry about it. Anything above and beyond that 7,000 or 6,970 to be exact would be at that 50% level. And then student assets are 20% of the formula. So if you have any custodial accounts, those are called UGMAs or UPMAs, those would be 20% of the FAFSA formula. And one really important takeaway I wanted to point out, if you look at the bottom of the page, you'll notice there's a 0% bucket. That's if a grandparent or another family member has a 529 plan for the benefit of your child. Fortunately, it does not have to be reported at all on the FAFSA, which is great news. And starting next year, if grandma and grandpa take money out of that 529, you don't have to count the distributions either. So just another really great benefit that if a grandma or grandpa wants to open a 529 for the benefit of your child or for the benefit of their grandchild, fortunately, it does not get counted on the FAFSA at all. So the next slide here actually helps illustrate what those numbers might look like hypothetically for your family. On the left, you'll notice is combined household income in purple, and you want to find your combined adjusted gross income on the left. Across the top are your total household assets. And the good news about that asset figure is that you don't have to worry about your retirement accounts. You also don't have to include your primary residence. So assets would include your checking or savings accounts, your non-qualified investment accounts, and anything else that you might hold that would be considered an asset for the family. And when you find the intersection of those two figures, your income and your assets, that is your expected family contribution, hypothetically. We actually used, if you look at the bottom left here, a special online calculator. And this is great because you can actually go out yourself to the US Department of Education's website. This hyperlink where it says online calculator in the bottom left is actually an interactive website. You can plug in your own family's parameters and it will generate what your expected family contribution might be. So I definitely encourage that if you might have a student approaching college age or if you have someone in college already. So the third segment that I wanted to go over is the solution, and that is the 529 plan. 529 plans were actually created back in 1996 by the federal government, and it is the premier way for families to invest for college. So I think of a 529 plan very much like a Roth IRA. It's after-tax dollars that get invested. It grows tax deferred. And as long as you use the money for one of the expenses listed off to the right here, so that's tuition and fees, room and board, books and supplies, special services if you might need a special tutor, computers and related equipment like a laptop, printers, or ink, those are all considered qualified education expenses. The federal government actually expanded on those a few years ago and makes 529s even more flexible yet. They included student loan payments up to $10,000 over the life of the 529 plan, K through 12 tuition. So if you have a student that's attending a private K through 12 school, good news is you can use the 529 plan for those, up to $10,000 a year per child. And then lastly, apprenticeship programs. So if your student might want to become an apprentice instead of going off to college or university, that's also an allowable 529 expense. So definitely wanted to help highlight those three new ones that are in green because those are relatively new for the 529. Getting back to the huge tax advantages of 529s, I also wanted to cover that for certain states, you'll also be eligible for what's called a state tax deduction. So some states have, if you make a contribution into that state plan, each year that you make that contribution, you may be eligible for a state tax deduction. So that makes them a little bit more attractive. The second major benefit that's listed here on the page is the estate planning benefit. It's a little known benefit within 529s, and it only exists within 529s where you can do something really special. Each year you can gift up to $15,000 per child, gift tax free. If you're married, you can double that. You can gift up to $30,000 gift tax free, but within 529 plans, you can accelerate that and multiply those numbers by 5. So an individual tax filer can gift up to $75,000 gift tax free, and a married couple can gift up to $150,000 gift tax free. And it really has that power of compounding that occurs right away and also removes that completely from the contributor's estate. So a lot of people love to use that as a huge estate planning benefit. And then the third major benefit that I wanted to cover on this page is the control and flexibility of 529s. Typically, there's one account owner for 529 plans. It's usually mom or dad. That person maintains full control over the account, even when the child reaches the age of majority. So unlike a custodial account, those are UGMAs or UPMAs, the student actually doesn't take over the account. Mom and dad can continue to hold that ownership. And that way they can help dictate that it is used towards a university or college expense and can't be used for anything else. The other flexible part of it is earlier I had talked about how I have two kids of my own, Joe and Kate. And if Joe does receive a scholarship or if he does have a leftover balance in his account, it's flexible in that I can simply change that balance to the name of his baby sister, Kate, and use that money for her. And you can actually do that up to first cousin. So for those of you that might be thinking about, what if I have a leftover balance, even when my youngest graduates from college, that'd be great. You can use that money up to first cousin. You can also use it for yourself. So we have some families where the parent wants to go back for an advanced degree, like an MBA, for example. They want to continue to get that state tax deduction by investing in the 529 and then use it for themselves for that qualified expense. We had a grandmother who called in last week, and she wants to attend culinary school. So she named herself as the beneficiary, and she'll be attending culinary school this winter. So I thought that was really neat as well. So very, very flexible within a 529 plan. The next slide that I wanted to cover is a little bit more on that estate planning benefit. So we talked a little bit about how every year you can gift up to $15,000 gift tax-free if you're an individual tax filer. And if you're married filing jointly, you can double that. You can gift up to $30,000 per child. Within a 529 plan, you can multiply that by 5. So we've just illustrated that $75,000 and $150,000 per child. But what I think is really neat is that when you extrapolate that out over the next 18 years, it really helps show that power of compounding. So for a $75,000 gift, growth over 18 years, and in this particular chart, we have illustrated 6% rate of return. Hypothetically, that account will grow up to $214,000 and should cover about 93% of 4 years of in-state public school costs. So really huge power of compounding there. And at the bottom, for the married couple that might gift $150,000, have that grow over the next 18 years, should grow to over $428,000 and should cover about 81% of 4 years of private school. So again, just really wanted to help illustrate that power of compounding and how much that one-time gift might achieve. And lastly, what I wanted to cover is grants and scholarships. This particular slide helps illustrate a lot of college planning websites that we utilize on our team and across the country, but especially wanted to point you to the upper right, the grants and scholarships portion. And a very popular website this particular year is goingmerry.com, that very first one listed there. What's neat about that particular site and a few of these others, excuse me, is that your college student can actually go out and create an online profile for themselves. And these particular websites help match them to a grant or scholarship that they may be a good fit for. And what I think is really neat is that they can actually apply for those grants and scholarships completely online. So it's a great way for them to go out, see which ones may be the best fit. And then also, if there is particular essay, a lot of these particular scholarships have pretty similar essays. You can simply cut and paste your answers. It makes it very, very simple to apply and help submit answers for the grants and scholarships. So definitely wanted to encourage families across the country to do that, especially because typically about $2 billion has gone unused in way of grants and scholarships, and definitely money to be had to help offset those really big college costs. So with that, I'm actually going to pause there. I did a lot of talking, covering the costs of college, the realities of financial aid, and then lastly, 529 plans and some grants and scholarship websites that you might consider for your college student. So with that, I'm actually going to pause there, John, and see if there might be any questions from the audience thus far, or definitely want to encourage, if you do have questions and you wanted to ask John and his team, definitely email the team and they'd be happy to take those offline as well.
Chris, thank you so much. I'm going to